What is risk? When dealing in the world of finance, there is always a potential for a financial risk that comes from uncertainty in investment decisions. It is the riskier investments that investors seek for higher returns, but they can also leave stockholders with the biggest losses. What are some different types of risk? A common risk is a risk that is linked across all outcomes. To use a glaring example of common risk in the insurance world, one would lean towards natural disasters. Hurricane Katrina, for example, essentially affected all homes in New Orleans, Louisiana. The damage from that hurricane resulted in all homes being linked in those damages. That would be considered a common risk. An independent risk, unlike common risks, are not linked or related to one another. A car accident, for example, is a good illustration of an independent risk. One car accident is not necessarily linked across to all of the other cars. How do you protect your stock portfolio from risks? You diversify. Diversification means averaging of independent risk in a large portfolio. By combining stocks into a larger portfolio and spreading investments over different industries, stockholders decrease the chances of independent risks and help to stabilize their portfolios and protect their customers' overall investments. It is difficult to anticipate or proactively avoid common risks like natural disasters, for example, but independent risks are less difficult to manage. To use the analogy from the last slide, for example, if you own several cars, the odds of any one specific car getting into an accident is much less than if you only had one car that you drove and used every single day. That is the same concept used in diversification. The downside, unfortunately, is that the safer your portfolio is, the less your anticipated return may be. Investors are rewarded for investing in the possibility of the unknown. That is just how the stock market works. You have to make riskier investments to get the most advantageous returns. Where you are in your life and what you're investing your money towards helps your stockbroker evaluate the acceptable risk in your portfolio. When is it okay to take a risk? If you are in your early 20s and saving for retirement, you are in a position where you can afford to make riskier investments because you have time on your side. Over the course of your career, as you get closer to retirement, higher anticipated returns in the beginning of your journey could lead to compounding dividends and huge net wins as you age, and risks that did not pay out have time to recover. This period of adulthood is when even small regular investments can make a huge impact. If you are in your middle age, you should probably look into a more balanced portfolio. You don't have as much time to let your money grow, so even a moderate loss could have a devastating effect on the overall health of your retirement portfolio. Without time left to recover, an obstacle like that might have an unsalvageable and permanent effect on your retirement savings plan. Your portfolio manager can compensate for obstacles like that by balancing your riskier stocks with safer ones. If you are closing in on retirement age, you should seek safer investments with little risk because you don't have time to absorb the highs and the lows of a volatile market, and you need to have exact and stable numbers to plan for your finances for the remainder of your non-working life. At this stage, a prudent financial advisor should be putting most, if not all, of your savings into a safe, low-risk investment option. Why is it important for you to understand risk? At the end of the day, you have to oversee your stock portfolio and determine your own susceptibility to risk. Growing portfolios infused over a long time with your entire life savings, of course, have the biggest potential to make the most money for your retirement. but not tracking and monitoring your portfolio carefully could lead to disaster. Unethical portfolio managers in the past have been able to invest huge sums of money in riskier investments when unsuspecting customers have chosen to trust them implicitly instead of monitoring their gains and losses with diligence. By understanding what risk category you are in and what risk level you are comfortable with, you can better oversee the progress of your portfolio and ensure periodically that your portfolio manager is addressing your needs and long-term financial goals.